everyone. I'm David Darst. I'm here to share with you as we begin the first part of 2023 some investment thoughts about some of the key issues that influence portfolio composition, asset allocation, and investment strategy. Let's start with inflation. Now, inflation has been moderating lately. Okay, it's come down 6%, 5.8%, 5.4%, 5.2%, and then the personal consumption expenditures index, as you know, that's the Fed's preferred measure of inflation on a core basis, stripping out food and energy. 4.4% was the latest number. So you see this moderation going on, and markets have liked it. They responded well. Stock prices are up, bond prices are up. Oil is down. Oil is basically down about 36% from its high last year. The dollar, another moderating influence. Now, the dollar's been weak this year, and that is inflationary. But for the previous 2 years, it was very strong. And that basically is a disinflationary force. And finally, you have less hawkish, less assertive, less aggressive Federal Reserve rhetoric in terms of tightening the screws monetarily from a policy standpoint. So these are some of the things that have been leading. Now, you've got these things called inflation swaps, okay? Inflation swaps. Now, labor is sticky. Labor costs have come down somewhat, but they're not down as much as some of the goods costs, okay? So your core services inflation is still elevated, whereas your core goods inflation is down quite a bit. 59% of the total components of the Standard & Poor's 500, of the Consumer Price Index, of the Consumer Price Index, 59% of the components are in actual deflation. That means they're negative year over year. They're in deflation. That is only about 32% of the weight of the Consumer Price Index. So you've got labor somewhat sticky, but easing off a little bit, not as much as the other things. Housing, the house prices begins to slowly transform and work itself into rents and owner's equivalent rent, and that is happening more slowly. But the inflation swaps and these inflation expectation markets are basically looking for, get this, by middle of this year, third quarter of this year, that you could see inflation down in the 2.5% to 3.5% range. That would be amazing. And if that's true, then stocks and equities, risk assets are going to be moving higher, We have told people, look, if you have a lot of cash, you maybe want to start putting some of it to work, knowing or fearing or realizing that some of it may go down. But you basically need to get on the train, because if we wait till June, July, August, when these inflation numbers, if everybody's correct and these swap markets are correct and inflation is much lower than it is today, stock prices, bond prices are going to be much higher than they are. Interest rates will be down, bond prices up, stock prices up. That brings us to monetary policy. Now, you have the Federal Open Market Committee meeting of January 31st, February 1st. The next one will be March 21st, 22nd, May 2nd and 3rd, June 13th and June 14th. Now, it's very possible, especially given the fact that the Bank of Canada, after they raised interest rates 25 basis points at their most recent meeting, they said we're going to pause and assess the impact of all the rate increases that we've made. You could possibly see the Fed saying something like this. You've got many houses, many Wall Street firms don't believe that, but the financial markets, the futures markets, are saying that if you get this moderation in inflation and slowing in the economy, then you'll see monetary policy begin to ease. Now, the Fed has two distinct mandates. Legislatively, this has been passed by Congress. First is price stability, and secondly is full employment. They also have two other mandates that are not explicit, but we know this. We know that the Fed basically watches asset prices. When I grew up in college and university and studying economics, basically the economy would make changes, the economy would grow and evolve, and that would influence financial asset prices. Today, the economy is so financialized. We call it CNBCification, the financialization of the economy. So many people's thoughts about spending, companies, individuals, investors, about spending is influenced by the scope and the growth or decline of asset prices. And the Fed knows this. So they have commented in their recent minutes of their FOMC meetings, they have commented saying, listen, asset prices are a little bit, they're easing. We're trying to tighten. They are easing. You've had the dollar down, okay? You've had oil down. You've had stocks and bonds prices up. So that basically puts people in a good mood. We're trying to basically reduce inflation psychology. The other part of the Fed's mandate, again, not explicit, is we think that the Fed knows that it's one of its roles. It's not on the books, but their role is to finance the government by printing money, to put money into the system if and when needed. And that means some forms of financial repression, keeping interest rates low, moderate, not letting them get out of hand, so that the government, in all this borrowing that it does, pays too high a bill. Now, the next few months will, I think, will give us a good indication of where the inflation in labor is going to go, because this is not the same, ladies and gentlemen, this is not the same as the 1970s and 1980s. There are many people who say, okay, fine, yeah, but this is just the first wave of inflation. And the Fed is so worried about making the same mistake that they made in the 70s, which is they basically eased off. And then they found the flames got higher and hotter, and they had to go in and really raise interest rates very, very high. Some people say they're going to have to do that again. No. Number one, the world is much more globalized. It's becoming a little less globalized, but it's still much more globalized than it was in the 1970s and 1960s. Secondly, oil is much less important in the economy today. In terms of the output per barrel of oil is much higher today than it was in the 70s. And third, the power and numerical strength of unions today is nowhere near what it was then. Those were three components that let inflation really get lit up after the Fed eased up in the 1970s. So we're in the camp that monetary policy, the Fed says they're going to keep it high for all through late this year and maybe through half or even all of 2024. We are thinking right now that along with the financial markets, that the Fed basically is going to say, well, we've done our job. Inflation is down meaningfully, and we can start to talk about not only pausing, but reducing interest rates. But again, that's in the second half of this year. Now, the economy, there's 3 or 4 factors that have been helping the economy. One is the dollar down this year. Secondly, China reopening, okay? Thirdly is less hawkish rhetoric. So those are the things on the side of the economy doing fine. On the side of the economy not doing so fine, listen to me. Retail sales down 1.1% in December, down 1% in November. So the consumer has been slackening off lately. You have the ISM manufacturing, ISM services indices. Both of these have moved into contraction territory. That means their number is below 50. You have the inverted yield curve, okay? And it is giving a signal. The 10-year minus the 2-year and the 10-year minus the 3-month. Both of those should be positive. In fact, they're negative, meaning the yield curves are inverted. The lead economic indicators have been declining for 7 or 8 months in a row. Now, where does this take us as far as earnings? Now, we think we're going to be in an earnings recession. That's at least 2 quarters where the earnings year over year are negative, okay? First quarter right now, this is according to FactSet, which collects the earnings estimates from all of the analysts all over the world. FactSet's looking for the first quarter to be minus 1.1%, second quarter minus 1.2%. We think those numbers are a bit generous and a bit high right now. $250 was the estimate for 2023 6 or 8 months ago, $250. Now it's $225. My personal view is it could easily be $210. Now, Morgan Stanley, some of these other houses are below. Deutsche Bank, 190, 195 for the S&P 500. If the S&P 500 does continue to have, why are earnings under such pressure? Number one is demand has been soft. Demand has been soft. The final demand number for the fourth quarter was only 4.2% versus 6.3% in the third quarter. This final demand strips out inventories and it strips out imports and exports. Our view is you could have easily an earnings recession. It could be larger than this 1% that right now, because the analysts tend to be a bit optimistic, a bit constructive, a bit sanguine, and they end up reducing their earnings forecast. Now, where does this get us in terms of positioning? We enter this year with some degree of caution. We recognize if this inflation number comes down to where it's going to be, and the Fed comes down to where they're going to be, you're going to have some significant moves upward in risk assets. We still like private equity. We like private credit. We like structured private credit for yield. The private equity is for growth. You could have some private real estate. Those, and again, manager selection is critically important there. Those are in the alternative space. In the liquid asset space, in equities, I think you're seeing some people begin to look at emerging markets and European equities in addition to U.S. equities. My thought is not so fast. Doesn't mean zero, but be very, very slow and cautious there. You want some companies that get exposure to the growth and opening in China. These are companies like Estee Lauder. These are companies like LVMH, okay? They just reported earnings. Revenues, 80-some billion dollars, 16% after-tax profit margin. And they say that the first part of the year, China looks like they're going to come back and really buy. They're not going to fly to Paris and Milan to buy, but they're going to buy in China. And then as the year goes on, they feel better about it. Then they will go to Europe and do some buying. So that's one of the things in the equity side. But really, our preference is for value. That would mean value is, listen, it's energy companies. Value is financials. I think financials, as this yield curve steepens, you could get some nice bargains in the financial space. Defensives are expensive right now. Their PEs have, everybody knows about healthcare. Everybody knows about consumer staples. Everybody knows about utilities. We like these, but you have to be, I think, a bit more careful, cautious, selective, and buy on a dollar cost averaging basis when you're going into this, the defensive area. Growth, you want to be very picky and choosy here. There are certain things going on in the technology space regarding artificial intelligence, regarding GPT, okay, where you have these pre-trained algorithms, and that's expected to basically be somewhat destabilizing, and you have regulatory authorities going after some of the big tech giants. So we don't think that the tech giants are going to go back to where they were when interest rates were extremely low, because many of those PE multiples were really boosted by the low interest rates. And on that note, we wish all of you a very happy, healthy, prosperous, and life-affirming 2023.